China is on the verge of deflation, and interest rate cuts aren't going to fix the problem. Good morning and welcome back to Morning Markets. Our focus today is going to be on China and the economy there and its sensitivity to interest rates. Recall that since COVID, central banks have raised interest rates in the G7 and are now on the cusp of lowering them. We've seen interest rate falls in Europe and in Canada, and markets are always looking forward or looking towards interest rates being decreased in both the US and in the UK. However, one major economy has been decreasing interest rates ever since COVID, and it is China. What are the reasons for this? Well, during COVID, China experienced a massive shock to its real estate economy. The economy there, so focused on investment in the real estate sector, has now been in recession in these commercially sensitive parts of the economy. And this has caused a savings shock and an economic shock. And interest rate cuts just aren't going to fix the problem there. This is because whereas savers in China typically put all their excess savings into the property market, they're now putting it into the bond market. And over the course of the week, we've seen the third plenum in China, which is a meeting of party leaders to try and philosophize on the outcome and outlook for the future economy. The outcome there is too philosophical, too focused on long-term objectives such as security, when in fact the economy needs radical transformation in the value of property. And yesterday's surprise interest rate cut from the People's Bank of China just doesn't address the problem. It was a cut of only 0.1%, taking the official lending rate down to around about 1.7% and the market interest rate of around about 3.5%. But of course, with inflation around zero, this implies that the real interest rate in China is somewhere between 2 to 4%. Now, when we've seen similar property busts in the West, such as following the global financial crisis, the real interest rate in the UK and the US eventually fell to zero and even went negative. So a real policy rate in China of somewhere north of 2 is still way too high for an economy which is reliant upon investment in the property sector. And the overhang of newly built but unsold properties in China is massive. It's equivalent to $1 trillion worth. So China will likely take several years to resolve its property bubble, and this will have prolonged consequences for growth in an economy which is aging rapidly. So what we should expect, and this is what the bond market in China is trying to reflect, is that interest rate cuts aren't over there. There are likely to be further efforts to stimulate the economy, mainly through the monetary policy channel. So that is likely to be cheaper loans for enterprises which are controlled by the state, so-called regional governments, but also lower interest rates available to borrowers. But of course, this won't have the stimulatory impact if borrowers just simply don't want to increase their debt loads anymore. So that's all for today, but please join us for our podcast, which this week will focus on markets, and please do like and subscribe on our YouTube channel. Thank you.